I come on this program, I do a 1-hour coaching session. This, okay, is going to be protracted. I pick one topic once a month and I mine it out. I pick topics that are timely, that are obviously useful, and then I go in, and again, like I say, the word mine it out means from top to bottom. I break it down like a jigsaw puzzle. I put it all back together to try to, in some way, shape, or form, help you improve your trading strategy. And today is dedicated exclusively to intraday trading strategies and setups. And notice how I broke it up into two parts. There's a strategy and there's a setup. And the thing is about this, okay, you may have the right strategy that fits you, but you got the wrong setup, and that's going to hurt your performance. Or you might have the right combination of indicator setups, but you don't have the right strategy. It's just not consistent. So it's a good idea for you to tune in today, because what I'm going to do is I'm going to walk you through a whole lot. There's a lot on the plate today, and it's in quite extensive detail. I got a lot of good slides, a lot of things, and we'll reference back and forth between the platform live and the slides I've got, but we'll spend pretty much the predominant time on the slides because I did a lot of, like I said, platform screenshots, so you'll get through it. Now again, if you've never seen this before, to the new Theo Trade members, it's a treat, okay? You're not going to find this in a book. You're not going to find this on television. You're not going to pretty much find this online, okay? It's like what I call unlocking the secrets of the market. But the thing is, nobody can guarantee that you're going to make money. Can't do that. Nobody can do that, and they did. You ought to run the other way. But what I can guarantee you is this. You're going to learn more today about how to manage an intraday trading type of posture, mindset, and how you look at your charts than you probably will that you've done in the last 10 years of your life. Now, I'm not here to change people's strategy. I'm not even here to tell you to change your setup. Here's what I'm saying. If you've got a setup and a strategy and you go through this particular program and don't want to change, that's okay. But just be open-minded. You may find after this program that you can tweak your strategy, or you can tweak your setup, or you could tweak both. That you may want to add one particular extra indicator, that you want to maybe remove another, or that you might go forward and say, you know what? I was using a 10-minute timing indicator. Maybe I should use 5 minutes, or I've been using 5 minutes. Maybe I should be using 30 minutes, okay? You might just make these subtle adjustments, and when you look at your trading blotter, you're trading more efficiently, you're trading more calmly, you're not spending as much on commission, and your performance, which is, they call it the profit factor, starts to improve dramatically. It's a metric or a gauge used to measure how much you're pulling in from trading against the costs that you're incurring for it. You can see my background here. I got 26. I'm actually on my 27th year now. Really dates me. You think Don's old? Okay. Don ain't got nothing on me. I'm a fossil. Okay. And I used to work with Don in the TD Ameritrade Trader Group. So we have kind of like a working relationship of, Oliver and Hardy. There's a little bit of tension there, but there's a mutual respect there in terms of the way he approaches the market and I approach the market. He's much more what I call quant, statistical analytics, option analytics, holistic, things that make sense that are very what I call obtuse. Me, I'm a little bit more plain vanilla. I'm a little bit more, technically oriented. Today, there is no fundamentals. Today, this entire discussion is going to be focused solely on technical indicators. I want you to sit back and I want you to evaluate things that are going on that I present and say, maybe you know it, but maybe you still need to make an adjustment. You're going to see things familiar. You're probably going to see things unfamiliar. Don't worry. I'm going to walk you through each single indicator and concept one by one and explain it and elaborate in detail. So if you have any questions, hold your questions towards the end of the program. I will tell you this right now. I am going to take a break at the hour-and-a-half marks at around 10:30 a.m. Central Standard Time because I'm in Chicago. I'm on Central Standard Time. I will take a break. You can go out, go to the bathroom, grab a bite to eat, have a cup of coffee, whatever, and then we'll start up in about 10 to 15 minutes, and then we'll take the program all the way through till 12:30 p.m. Central Standard Time. Like I said, I talked with Don yesterday. I talked with Jeff Roth. I want to open up the forum to questions. I know there's going to be a lot of questions, and I'm here for you on your questions. So hold them to the end, write them down on a piece of paper, okay, and we'll address them at that point. But let's kind of move what I call furtively at a certain pace to get through this. We've got a lot of slides, so I'm not in a hurry, right? but I'm going to move at a certain, like, sort of accelerated pace at times. Okay, what is the learning objective that you're supposed to take home from today? What are you supposed to ascertain? Well, first off, here's one. I want you to define the specific characteristics, rules, and constraints that constitute intraday trading. See, you think you know intraday trading, but there's different intraday trading strategies, and a lot of people don't really, they just say, well, I'm a contrarian, but they don't explain what that means. Oh, I'm a momentum, but they don't explain what that means. Or, hey, you know what? I'm a swing trader. And yes, you can be an intraday swing trader, but there's not really an applied definition of what that means. I'm here, okay, to kind of fill that gap, to close that fissure and let you know what does it mean when they actually apply or define these strategies. So it's not just going to be what I call, auditory. I'm going to provide visual optics and cues so you can understand what these concepts mean. Number two, I want you to learn how to explain concisely the differences between the primary factions of intraday trading strategies. I want you to not only understand them, but how to separate and distinguish between the two of them. Because a lot of times people do what's called, well, I'm an intraday trend trader. But I say, well, do you know what intraday momentum trading is? And they say, it's the same thing. It's not the same thing. I want you to be able to actually not just define it, but understand the differences between them. I'm not telling you what type of intraday trader to be. I'm not even telling you that you have to intraday trade. But a lot of you make a living off of intraday trading. I'm telling you, you can't be all things to yourself. Okay? I've never met traders who trade for a living, prop traders who go, I'm swing, I'm market neutral, I'm momentum, and I'm trend. You can't do it. You just gravitate towards one strategy and you stick to it. My joke last night at DePaul when I was teaching the class, I said, look, McDonald's sells burgers. They're not a dry cleaner. Okay? Be what you are. Don't try to be too many things to try to prove yourself with all these strategies. Focus on one strategy, right? Exploit it, become the best at it, right? Optimize one strategy. Number three, understand both the driving forces and the subtle nuances behind the intraday technical indicator covered in this symposium. So I'm going to throw you a lot of different indicators, some, again, which you're familiar with, some which might be kind of new, and others which might be convoluted. I'll try to kind of simplify them as I can, but I want you to understand the differences and the subtle nuances behind each one of these so that you can adapt each one that you need to your intraday trading, what I call tool set. You don't need to overlap. A lot of new members come in and like, I need 3 momentum indicators. You don't. At most you need 2, at least you need 1. Keep things under control. Keep it really simple. The more simple, the better. In this particular type of venue, intraday trading, less is actually more, and I'll show you as we move on. Number 4, I want you to adopt an intraday trading strategy that matches your mindset. And I'm not stealing from Doc. Doc's got, Monday mindset, but again, mindset's important. I call mindset and comfort zone like 2 separate things. Mindset is how you focus. That's your objective. That's your mind. That's your acumen. That's your senses, your mental senses and faculties. Comfort zone is your emotions. Sometimes, you're focused, but you're emotionally just like a shell shocked. And other times you're emotionally comfortable, but you just don't have a grasp of the indicators that you're using. I want you to kind of meld them together like a Venn diagram where they overlap, where both your mindset and your comfort zone are in a happy place. Because once you reach that happy place, your trading becomes more fluid, Kim. It becomes more, like I said, like Zen. And then you start to do what? Post profits more consistently and don't mismanage your risk. Moving forward, okay? What other parts of the statement, the learning objectives, do I want you to learn? I want you to determine the underlying product or set of products you prefer to trade on an intraday basis. Don't force the issue. Tony Rako is a master at trading the NQ. That doesn't mean you have to trade the NQ. It's good to listen to Tony, the spots, what they owe you, okay, the risk in, risk out. Listening to Tony, listening to Doc and Don. It's all part and parcel of what we do at TheoTrade, but we're not all cut out of the same cloth. If you don't want to trade futures, don't force the issue. Me, I trade futures less than 5% of the time. 95% of all my intraday trades are stocks. Okay? I love boring stocks. I trade CSX, Abbott Labs, Bed Bath & Beyond, General Electric, all the crap that nobody wants to touch. But it's my comfort zone and it's my mindset. Okay? So again, figure out whether you want to trade futures or stock or a combination, but don't go overboard and just say, well, Doc trades the YMs. Doesn't mean you have to. Find your happy place or find your happy product. Number 6, I want you to select a visual mode. What do I mean by visual mode? Well, the optics are everything in here. You can't trade blindly. You can't trade with your eyes closed. Your mind will see things. It will process information. And usually the information you process is what? Graphs, charts, geometric shapes, lines, curved lines, right? That's what we're talking about here. So what we're talking about here is time-based charts, transaction-based charts, or strictly what's called price-based charts. I'm going to show you the full Monty, and it's going to fit effectively with your trading style and optical perception. Me, I can't trade ticks. I understand ticks probably as well as anybody who walks this planet. I don't like them. I understand them, but I don't like them. It's not my style. Me, I'm more of the ilk of trading what's called time-based charts, right? And price-based charts, which are what? They have no time at all inside the chart at all. It's not driven by time. It's purely price and price only. Tony Rago, he's all about price. Doc Severson, he's all about price. But Doc Severson will actually use transaction-based, which are ticks, and Tony will actually use time-based charts, even though he doesn't care about, segments of candles. All he cares about is the candle itself, but not the time segment attached to the candle in terms of the increment. He doesn't care, and that's okay. But you got to make it fit with your trading style and your optical perception. Number on this list is that was number 6. Number 7, is it number 7? Yeah, I'm not sure. We'll have to look back. But I want you to decide on a suite meaning a collection of technical indicators that are uniquely, and I love the word uniquely. Unique means yours, not your neighbor's, not mine, not Don's, because I get emails, show me your setup. I can show you my setup all you want. It doesn't mean it's right for you. It doesn't mean it fits with your comfort zone or your mindset. But I can give it to you. It has to be unique, or what I call, to oneself. That's what I mean by that. It has to be consistent with your strategy criteria, which includes things like volatility, your time frame, how long you're going to stay in the trade, right? Your visual mode, how you interpret the data, liquidity, the bid-offer spreads, how many shares are trading, how many contracts. You're trading an illiquid product in an intraday basis, okay? You're barking up the wrong tree. You get into a trade intraday and you find yourself unable to get out by the end of the day, and you start to panic. Well, why is that? Well, everything fit in place. You like the volatility, you like the time frame, you like the visual mode. You just did what? You dropped the ball when it came to liquidity. You can't do that. All of these things have to come into play. You can't put any less weight on any of them. They're all equally important, because if one of these pillars of your strategy is out of whack, your whole strategy can come unraveled very quickly. Last but not least, your comfort zone and, of course, your trading style. Number 8 or number 9, not sure, but again, we'll just run with it here, right? The idea is this. I want you to be able to integrate a combination of technical indicators, I don't know where my mouse went, there it is, technical indicators, into your intraday trading setup and consistently monitor them for performance adjustment optimization purposes. What does that mean? Okay, it's a mouthful. Here's what that means. It simply means this. You finally watch this entire symposium. You figure out the product you want to trade, right? Or a couple of products or suite of products. Then you figure out what your trading strategy is, right? Then you figure out what your trading setup is. So it's a step-by-step process. Pick the product, pick the strategy, okay? Pick the setup and put it all together and then go trade. Okay, it doesn't work like that. That's the front half. That's what I call the front end, but you're missing the back end. And people are like, what do you mean by back end? What exactly does that mean? The back end of it simply means this, is that, once you get your strategy together, what's the other half of your strategy? You have to monitor it. You have to check it day by day by day, okay? You don't just drop it off there and go, it's going to work every day. You don't need to change it every day. You may only want to change it once every few months, but you still need to monitor your performance and see whether or not, okay, you're getting an edge or you're not getting an edge, whether you're making money or losing money. You want to optimize, okay, your trading strategy and setup so you're getting what? Complete efficiency out of your trading. You have very little slippage, you cut your losses quickly, you book your gains, and you move to the next trade. It's going to be like systematic. But in order to reach that systematic optimized level, it requires you come in here day after day after day, monitor your performance, see where your weaknesses are, see where your strengths are, and do less of what's not working, do more of what is working, so that it requires adjustment processes along the way. And that's not a bad thing. All right, moving forward, okay? First thing I want to talk about, okay, is what's called momentum trading strategies. We'll get into the setup second. Like, that's the second part of the program. There'll be an overlap in the first part of the program to get you kind of moving along in terms of your setups. A lot of you already have your strategy established. So you're looking at this program now going, oh my God, is he going to have to kill an hour with the strategies? The answer is yes. Why? Because there are new people in Theo Trade who have not had exposure to some of these strategies and want to try intraday trading. There are others who are already inculcated in the intraday trading forum. They've been doing this for years, but they want to entertain the idea of actually switching their intraday trading strategy because it hasn't been met with the success or the efficiency that they would have hoped. So I'm trying to reach all audiences out there, newbies, right? People who have been in the business for a short period of time, or people who have been doing this, and veterans like myself for years, because we're all going to gain from this, including myself as I go along this. So the first type of intraday trading strategy, which is the most famous, this is the one that dominates today's market, okay? It's not old school, it's new school. But don't assume because it's new school, it's right for you. For some traders, they live and die by this. I call it live by the sword, die by the sword. Other traders who trade by this, right, they don't sleep well at night. Other traders look at this like myself, because I'm not a momentum trader, and I'm like, I can't trade like this. Okay, it doesn't fit my style, it doesn't fit my comfort zone or my mindset. But nevertheless, I teach it because there are some people who like to have the thrill of living on the edge and not fighting the tape, so to speak. So the momentum trading strategy goes like this. Momentum trading seeks to capture profits in securities. And when I say securities, it doesn't have to be stocks. It could be commodities, it could be futures, okay, whatever your product of choice is, okay, that are making significant price moves up or down. Don't think of momentum as like a one-way ticket up. Okay, momentum includes shorting the thing to death and it's dropping like a stone. I call it a cement kite, right? On heavy volume, often in reaction to a news or rumor catalyst. So momentum trading usually has a trigger behind it. Usually it's rumor, it's news, and it's usually accompanied by heavy volume. Momentum traders are drawn to securities that move in an extreme, that's the key word, extreme, and often excessive manner. Okay, did you watch the tape, everybody, yesterday? That is momentum trading. Buy, 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 panic buy, get in, at any price. That is momentum trading. You're just getting on board the tidal wave and riding it, okay, and picking your spot where to get off before what? Before it all blows up on you. It's about price volatility. So when you talk about momentum trading, literally the key concept is price volatility. What's it a function of? What's it due to? Could be gaps, could be short squeeze, which is what yesterday was, margin calls, and running stop losses. People have orders in there and they're just like, they're just executing orders and it's feeding on itself like a bad rash. All right? Third part of momentum trading. Scalping quick profits with heavier leverage is the typical style of momentum traders. High risk can be proportionate to large rewards. So momentum trading is about taking it's not about what I call picking up nickels in front of a bulldozer. That's not momentum trading. Momentum trading is a high risk, like all or none type of deal. You're trying to take things in chunks. You're not trying to do things in like small, little, like what I call like measured portions. Me, I'm a measured portion trader. I get a little here, a little there, and I go to bed at night and sleep well. Momentum traders, okay, they go for the gusto. They're trying to capture as much money as possible in a very short window, so they ride the wave up or down. Stocks that have sustained a parabolic rise, i.e. yesterday, there were some huge moves. Amazon up like 27 and only ended up 13. Yeah, you got burned for 14 points if you chased at the high. Depends where you got in to capture that money. But stocks that have sustained a parabolic rise are often labeled momentum stocks or high flyers. Don't assume a high flyer is a triple-digit stock. It could be a $20 stock. It could be a $50 stock. It's how fast it moves. Yesterday, I saw CSX up $2 in 4 minutes. That's not a $100 stock. That's $50. But it moves fast and it flies high quickly. Their volatility attracts momentum traders, spurring a spike in participants. So one thing you'll learn about momentum trading people is this. There typically is a lot more volume embedded in momentum trading. GE is not a momentum trading stock. It's not. It's got really heavy volume. But if you look across the board at really heavy volume stocks, okay, you'll notice one thing. Typically, they're momentum stocks. Apple, Applied Materials, okay, Amazon, Okay, they've got really good liquidity. They're premium momentum stocks. Okay, so here's an idea. Here's a what I call a graphical depiction, okay, of what a momentum stock tends to look like. Okay, first off, you see the volatility. The volatility does what? It signifies significant price movement. Then what happens? What happens is once the volatility begins, what follows is liquidity. It's the ability to buy and sell with ease. So volatility attracts liquidity. It's not that liquidity attracts volatility. It's not the other way around. Volatility comes first, then the liquidity follows. That's a typical momentum play when you're dealing with it. When you put these two together as a formula, momentum traders have ideal trading opportunities. So if you decide after today that you want to be a momentum trader, Jeff, I can't stand it. I was a scalper. I was market neutral. I was contrarian. Fine. You want to be a momentum trader? Okay. You got to understand it's all about volatility, where the greater the gains can also suffer greater the losses if you can't get out in time. And it's all about liquidity. Liquidity comes in waves in momentum stocks. You blink, next thing you know, the stock's up $3. What? Too much liquidity can move the thing like crazy. That's one thing you learn about momentum stocks. They tend to draw in tons of liquidity, order flow in a short window. So if you're on the wrong side of the trade, it could run you over. And if you're on the right side of the trade, it could vault you into quick profitability. But with that vault into quick profitability, you must scale out quickly, because as fast as the profits come, they can leave even faster. And if you don't believe me, look at yesterday's tape. It's a prime example. All right. So what does a momentum trading configuration look like if I could show you graphically? Well, I have this as the YMs, and this is a few months back. It's last December, and this is a 1 minute chart. It's not today. It was whatever day it was, the day I chose, which was December 16th. And here's a 5 minute chart. I want you to take a look at this, okay? Notice there's volatility. Like there's a surge there, then there's a backing off, then there's a surge there, then there's a surge down. Then there's a surge up. Then there's a surge down. Like you don't think there's a lot of volatility here? You couldn't be farther from the truth. Look, there's 24,200 there. And by the time you blink, in 25 minutes later, okay, you've already lost 80 points. 80 points. Like boom, you blink and it's already moved a third of 1%. That's momentum trading. Momentum trading has what's called surges in moves. You don't see a lot of chop. It's a surge and a back off and a surge and a back off. But this just happened to be a two-sided market that day. And when you look at this momentum indicator, this just trading configuration, what you notice is this. The histogram reflects the momentum. So when the histogram, okay, goes to the upside with a greater bar versus the previous bar, what do you notice? Greater momentum, greater push. So as it's attracting liquidity, the bars get longer and longer and longer. Then they have short bars that back off. And you see that? The longer the candlestick, the greater the price volatility, the greater the what? The liquidity. So what you're seeing here is that price volatility, then it's like a vacuum. It sucks in the liquidity and forces what? Big swings in momentum-based moves. And this just captures it in a histogram form. It swings up, it peaks, and then it swings down and peaks to the downside. So this histogram is kind of like amplitude on your old radio, where you can see when the volume's up or the price volatility is up, so to speak, and when it kind of starts to wane and then drop back down. This is just an idea of what real volatility looks like, right, as it relates to momentum trading. Now, let's talk about a second particular type of trading strategy. Second one here, swing trading. Don't confuse swing trading with momentum trading. Now again, in the previous example that I showed, that was a momentum trading configuration using the histogram bars to sort of illuminate what I'm talking about and the price swings up and down. Swing trading isn't necessarily, okay, about momentum. It can be. It can be a byproduct of momentum. But swing trading is the idea that it's a two-sided market. You may walk into the market some days and it's just all up. Like yesterday morning for 6 hours, 5.5 hours, it was just up, parabolic, sucking the wind out of the shorts. Buy. That's momentum trading. It wasn't two-sided until the last half hour, right, when everybody realized they got gamed by the system. Because why? Because interest rates were moving higher, and by the time they sold, the momentum then swung to the downside. Okay? Swing trading is different. Swing trading seeks to capture profits by exploiting reversals or swings. So in a swing trade, you could play it all to one side. You could say to me, Jeff, I'm a swing trader, but I only buy into dips. Jeff, I'm a swing trader. I only short into rallies. Or you could play both sides like me and Don. What does that mean? I'm a swing trader, but I like to buy when it's what? About to turn and go up, and I like to short and sell it when it's about to reverse and go down. So swing trading is this kind of like back and forth type of look, and I'll show you the graphic. Swing trading is a form of momentum trading, like I said, with the principal difference though. Swing trading can be two-sided where momentum trading is only one-sided. That's the big difference. And momentum trading usually has greater price volatility on any given day. Identifying when to enter and exit a trade is the primary challenge for all swing trading strategies. However, I say however, because there's always a caveat, swing traders do not need perfect timing to buy at the very bottom and sell at the very type of price oscillations to make a profit. What does that mean? If you're a momentum trader, okay, timing, you have to buy, your timing has to be that more precise. When you're a swing trader, your timing can be less precise. Because why? Because you're playing both sides of the trade, whereas a momentum, you're usually playing one side of the trade. So keep that in mind. Now, the risk of loss in swing trading typically increases in a trading range. So the greater the range, the greater you will suffer losses or, okay, reap gains, or sideways price movement as compared to a bull or bear market that is clearly moving in a specific direction. The one thing traders like to do, and this is most traders I've met off a prop desk are momentum traders. That's just the one, and trend traders. They're not swing traders. They don't play both sides. They never fight whatever the primary trend is, and they just keep buying into it with their own strategies and setups. But here's the thing, okay? In a bull market, right, it's usually moving in one direction. It's not moving, swing up, swing down. We've been in a bull market now for 9 years of virtually no price volatility. It's literally been bid the whole way through with like 2 corrections in between. Well, that's starting to change. But you have to recognize what the primary trend is and understand that in a swing trading, that if you're fighting the primary trend, taking the other side of the trade at times, okay, you may be in for a rude awakening, like you come in every day and go, but the market's been up 6 days in a row. Today I'm going to play the swing trading short side, and it goes up for a 7th day. Well, why is that? Okay, here's why. You're in a bull market. You're fighting a bull market, so you're better off swing trading, but only playing one side of the market instead of both sides of the market. So you need to do a heat check every day and seeing whether there's volatility or no volatility, or where the primary theme is. Is the primary theme bullish, bearish, or neutral, or volatile? Okay, every day you come in as a swing trader, you have to be that much more in tune with the trend of that day. Whereas the momentum traders, right, all they do is plug in and play where the big price movements are off the volatility. It's a little bit different. So here's the basic concept of swing trading. You identify a trend, right, and here's a trend going up, okay, and you say to yourself, well, if it's going up, the trend's up, how should I play it? To the long side. Oh, well, there's a pullback. All of a sudden there's a pullback. So it pulls back to some type of support level, and the trend starts up again. So you're going to buy every time when the trend starts to resume. You're not necessarily fighting the primary trend, but what you're doing is you're just trying to find when that trend, the primary trend, is supposed to reemerge. And I'm not talking about a primary trend for a day, for like a month or a week. We're talking intraday. So you got to come in, spend 15 minutes watching your screen, getting a feel for the market and the order flow, seeing what the primary trend is telling you on your product, right? And trade in the direction of the way your product's moving, but just capturing it in a stair-step fashion. So you identify the trend, you enter on the pullback, and then the trend resumes. And once it resumes, you have to exit just before the trend ends. That's the primary part of this. Now, let's talk about intraday trading strategies for what's called channel trading. It's a different animal when it comes to channel trading. People like, there's another type of trading strategy outside of swing trading and momentum trading. Ladies and gentlemen, there's all kinds of like mixed and matched hybrid strategies within momentum and within swing trading, where they actually kind of like mix and match them and create new words. And I'm not kidding you, but here's the thing. A channel is defined as the area between 2 parallel trend lines and is often taken as a measure of a trading range. So this is a range-bound strategy. The upper trend line connects the price peaks or the highs or the closes, and the lower trend line connects lows or closes at the bottom side. Trading price channels means what? Trading a range wherein Areas of support and resistance are pinpointed for entry and exit. So when you're a channel trader, here's the thing you got to keep in mind. You don't buy in the middle of the channel. That's what momentum traders do. You're not a momentum trader if you're a channel trader. If you're a channel trader, you buy at the bottom of the channel or you sell at the top of the channel. That's your strategy. You're playing at the far extremes, whereas momentum traders play in between the lines. That's the difference. Channel trading is relegating to trading at a point near support and resistance levels and not when prices reside between those levels, as I just said. Support and resistance levels that define a price channel are characterized by what? Excess liquidity, meaning either supply over demand or order flow or vice versa. In other words, at the top of a channel, too much supply. At the bottom of the channel, too much demand. One or the other is going to dominate. It's a supply and demand equation, people. It's one or the other. So at the top of the channel, your recognition is what? Too much supply, so I sell my underlying or I short it. At the bottom of the channel, you do what? You cover your short position or you go long because it's what? Excess demand over supply. That's how it works. So let me give you an example of what I mean by this, okay? Here's an intraday channel trading configuration. Like, here's an ascending, okay? People like, I thought all channels were horizontal. No. Me personally, I trade horizontal channels. But some traders don't trade horizontal channels. They trade ascending channels. So where there's higher highs, that's the pattern, or higher lows, they'll play it. So look at this. They sell here, they buy here. They sell here, they buy here. Or they short here and cover here. Go long here, sell here, flatten out short, and come down here. It's a channel trade. Okay, see how that plays out? Now here's a descending channel trade. What's the primary trend? Well, the primary trend's down. So if the primary trend's down, how do the channel traders do it? Well, they recognize their lower highs. See how the highs keep going? There's a high there and a high there and a high there. They're lower highs, but there's also lower lows. So the trend is kind of just going into oblivion, lower and lower. So every time you tag the top of that ascending or descending channel, you sell it. So you could buy here or just not buy at all and say, hey, it's a descending channel. Short here, cover here. Or short here, if it breaks out of the channel, what must you do? Cover immediately. The idea here is not to let your losses run away. Short here, cover here. Short at the top of the channel, buy at the bottom of the channel where there's support. So it looks like a form of swing trading, but it's not necessarily. Because swing trading doesn't have a defined channel. Got that? Channel trading does. Your last channel trading, which is my favorite, this is who Jeff Bierman, meet me, I'm the ultimate channel trader. I just do what? It's got equal highs and equal lows. So at the top of the channel, what am I doing? I'm shorting it. When I got a little bit of a stop above it, and I cover my short position as close to the bottom of the channel as possible, so I recognize, the data points where there's clustering of resistance and support. That's what we're talking about with channel configurations. This is a fabulous, fabulous graphic that I pulled up. All right. Let's go back one slide, all right? Wait 1 second. I don't want to go too fast. All right. Now, we've talked about 3 trading strategies today, okay? There's more. There's actually technically 6, and with the hybrid mixtures, it adds up to 10. I don't have time to go into 10 strategies. I chose the 3 most popular, bread and butter, like worldwide, the word Catholic means, worldwide acceptance. It's like a standard. It's a Catholic trading strategy. Every prop desk I ever worked on either has one of those 3 trading strategies embedded on it. Channel, swing, or momentum. Now that you've got that out of the way, the next step in this particular program is what I call trading optics. And people are like, what do you mean by optics? Well, now that you've learned what the different strategies are, what must happen then? Well, you have to come to a conclusion about how you're going to design your visuals. You don't trade in a vacuum. You don't trade with your eyes closed. You're not trading necessarily off of numbers. You're looking at price charts and you're adding studies or indicators accordingly to help you kind of gauge and manage your trades. I mean, that's kind of what it's about after all. So on intraday charting trade modes, I use the word mode. Think of the word mode as this. Don't think of the word mode as an indicator. Think of the word mode as a visual cue or a visual optic, the way you're processing information. So when I say visuals, visuals are like rectangles, boxes, triangles, lines, bars, things of that nature. Just normal patterns of things that are actually put together to help you decipher price action. Okay? They're broken into two different categories in terms of the modes. There's time-based modes and there's price-based modes. Time and price. Price-based are time agnostic. In a price-based mode, time doesn't mean anything. It means nada. There is no time. All you care about is the actual price that's being painted or plotted on your chart. There's more price-based, right, than there are time-based, but don't let that fool you. These are a little bit more complex. They're a little bit more skewed, but a lot of intraday traders lean on these versus these. These are more traditional. These are more what I call new age, new wave, sophistiqué. When you make your choice for either one, and we'll get into it right now, okay, use one and one only. Don't use bar charts and then come over here and go, I'm using bar charts with tick. Gonna screw you up horribly. You gotta settle on one and one only. Consistency is everything when it comes to intraday trading strategies. You must be systematic. And a system can't have 7 different chart modes. It can only have 1 or 2 at the most. Doc, he does ticks. Tony, he does candles. Me, I do Heikin-Ashi. Okay? Like I said, it takes a village. Make sure you settle on what you like. So let's go into each one. Let's look at a time-based one. Here's a time-based one, a bar. So what is a bar? Well, a bar does not include what's called a candlestick. A candlestick shows the body of the candle. There's no body. In fact, there's no candle at all. This is just simply, what? A bar in itself. That's the high, that's the low. The open is what I call the heel, and the close is the shoulder. Now, if you map this out with a candle, then you become a candlestick. But some traders, and the traders I worked with for long periods of time, they hate candlesticks. Colorized candlesticks throw them off. All they care about is where it opens and where it closes and what the range is. It helps them actually decipher, right, and read the data better because it's so what's called simplified. It's so lucid and clear. They're not encumbered with all these different colors and different types of candlesticks like a doji, or it's a three river bottom, or it's advancing soldiers, or it's a deliberation candle. That screws them up. They want simplicity because they're making quick decisions. They're making snap decisions, and the more simple, the better. Like I said, at times, less is more. Then you've got what's called time-based candlesticks. And again, they're time-based because every single candlestick has the same time interval. Some are set to 5 minutes. Some are set to 1 minute. Don's like an ostrich on crack. He loves the 1 minute candles. He needs fast information, and he can't get it fast enough. Me, I'm a cut out of a different cloth. I may talk fast, I may think fast, but I try to slow down everything to a crawl. That's why I use candlesticks. I don't like the idea of a 1 minute candle. For me, 5 minutes is like at the speed of light. I typically use 10-minute candles and 13 to 15-minute candles. That's Jeff Bierman. But again, I'm not Don. Don likes it quick. I like the smoothing factor, but with the smoothing factor comes a lag. So you can see how to read the Japanese candlesticks in this graphic. The top of the body, and this one, okay, is the opening price for a red candle. Right there is the opening price. That's the closing price. The bottom of the body is the close for this reddish candle. Note the candle has no wick. It opened and fell straight down till close. That's a Maribozu. Then some candles have wicks. They call them shadows. That's an actual shadow. That's a shadow. In this graphic, notice how they call the shadows wicks. It's just interchangeable. It's the same thing. That's the body of the candle. And in a red candle, it opens up on the shoulder. It closes on the heel. In this blue candle, and on the Thinkorswim platform, it's a hollow green candle, right? It opens where? It opens on the heel. It closes on the shoulder. That's the high print. That's the low print. And again, the body of the candle just signifies the open and the close, where it opened and where it closed. There's a spinning top, a bearish spinning top. Okay, in this example, the body is the opening price for this candle. Over here is the opening price. The closing price is higher, so it's a bullish candle. Another bullish candle that opened higher above the previous closed even higher up here. So the bottom of this wick is the low price for that candle. The top of the wick is the high price. The wicks mark the range, right? And the open and the close mark what's called the body. Completely separate, but these are Japanese candlesticks, okay? Then you got what's called another set of time-based candlesticks called Heikinashi candles. Okay, Heikinashi means what? It means even paced. That's what it does. It means average pace or even pace. So what the Heikinashi does is it takes the previous open, high, low, close data, and then it plugs it into today's open, high, low, close data, and then it averages it out. So in Heikinashi candles, they're completely different than the pure candle that you just saw because they're modified. They're plugged into a formula. So candlesticks are what's called unfettered. They're pure. This is not unfettered. It's not pure. It's modified. It's manufactured. It's not changing up the data, but by plugging in a formula, it colorizes the trend. This is my particular choice. This is Heikinashi bearish because it's red filled. This is Heikinashi bullish because it's hollow green. And notice how these are like momentum-based candles. If you're a momentum trader, and again, stick with the program. We got a long way to go. If you're a momentum trader, okay, my suggestion is marry yourself to the Heikinashi. The Heikinashi is built and designed for momentum traders. I'm not a momentum trader, but I use it nevertheless because I'm looking for what? When momentum runs bone dry, because I'm a channel trader. I like to see it hit the top of a channel, turn and looks like this, which gives me a sell signal, and then enter the trade. I don't usually hit the top of my trades, but I'm not far off in terms of capturing the reversal move. So you see the bullish here and the bearish there, and this is Lululemon on a 1 day 5 minutes. So this is a 5-minute Heikinashi. Remember, this is a time-based candle. So if you have a 10-minute candle on a Heikinashi, it's going to look different than a 5-minute candle. You say to me, Jeff, I've got a 30-minute candle. That's going to look completely different than a 5-minute candle. Because what? Because it's a function of time, people. They're driven by time. Most traders that I've traded with my life for 30 years, they hate time-based charts, and that's okay. They want to filter out time because time screws them up. Time means what? There's a lag embedded. They have to wait for a colorized candle to print before they can enter a trade, and they may miss the trade altogether. They would rather trade solely off of price action and not when the actual candle is completed because it's tied to a segmented time period. We'll get into that next. So I just want you to recognize what the Heikinashi looks like. And by the way, I will show you how to add the Heikinashi later in the program. Okay. Now we're going to move to what's called price-based or what's called time agnostic. Agnostic, obviously people like, I'm agnostic. Agnostic kind of implies that you don't believe in God, okay? This isn't about God. Time agnostic means you don't believe in time. It means remove time and filter it out altogether. So if you look down here, here's 11:20, here's 11:25, here's 12, here's 12:15, okay? These are based upon what? They're not based upon equal segments. They're based upon transactions. So each bar, each one of these bars, it represents the price activity of 333 market transactions irrespective of time. So if in this example of the E-mini, if one contract goes up, that's a transaction. And then a split second later, 30 contracts goes off from a large institution. That's also a transaction. So in a transaction-based chart, volume means nothing. It doesn't matter if it's, one contract or 100. The size of the contract just doesn't matter. What matters is what? The printing of the actual transaction tick. There's either upticks, downticks, or flat ticks. So when 333 ticks are completed, or 333 individual transactions, regardless of size, then the next tick bar paints. So they often call this the EKG, the electrocardiogram, the heartbeat of the market, because it has nothing to do with price per se, in terms of segmented of price, and it has nothing to do with time. It's just purely trades going off. So what are you doing? You're basically monitoring order flow at the deepest, darkest level of the market. Rather than standing outside of the market, you're on the floor of the market like you're a specialist, seeing the order flow firsthand. Most of the traders I trade with love this stuff. Doc Severson loves this. Don, he likes it but doesn't love it. But to love this means you have to spend a quality time getting familiarized with it. All right. Then you have what's called range bars. Now, when you look at this range bar, your first thought process is, but that looks just like a bar chart. It does. It is a bar chart. But the rules of a range bar are much more constrained than the rules of what? Of a range bar. Because the range bar is defined by a price, a price range. A regular bar that you saw in the first example is like, there is no definition. It's not constrained by any size or range of the bar. It could be $3 or 1 tick or 25 cents. It doesn't make a difference. This is every single range bar is the same what? Range. Look, they're all $4. Look at the NQ. This is a time where I picked in December where the ATR, the average true range, the average range of every single price movement throughout the day was $4. So again, you see the range bars, they're all set to $4. What happens when it goes beyond $4? Simple. A new range bar is painted or plotted. See how that works? It's always a function of what? Price, never a function of time. But to create a new range bar, you have to go outside the constraint, which is the $4, up or down. See, once it breaks up above $4, it starts a new range bar. And if that stays in a $4 range, once it goes outside that $4 range, it starts a new one. So you see it stair step up and stair step down. One of the things you'll see with these what's called time agnostic modes, one of the beauties of them, they cut through all the damn noise. They get right to the point, okay? They slow down the order flow so you can see in optically what's going on in terms of trend, reversal of trend, and emergence of trend. Okay? I'm not telling you one is better than the other. What I'm telling you is you got to find your groove. Like how Stella got her groove back. You got to find your groove. You got to find which one of these fits you. Which one of these, like, I like this one the best. It matches my mindset, how I can process the information, and it matches my comfort zone. Why? Because my comfort zone's about my emotions, how I absorb, body blows from good and bad trades. This tells you you're looking at $4 risk movements. This is a comfort zone for a lot of traders because of the predefined what? The predefined range of the bar. Then you have momentum bars. They're a lot like range bars, but there's a different rule applied to momentum bars. So momentum and range have a tremendous similarity. There's a huge overlap. If this were a Venn diagram, huge overlap. But they're not necessarily bound by the same rules. But one thing they do have in common is they're bound by ranges. The one thing about momentum bars, guess what? People who are momentum traders tend to use momentum bars. People who are channel traders tend to use, range bars. See how that works? So these particular chart modes are specifically and uniquely defined for a trading style. So if you don't like price-based charts and you like time-agnostic charts and you're a momentum trader, this might serve you well. Or if you're a channel trader who doesn't like time-based charts because of the lag, then you might attach yourself to what? A range bar. That's why I brought this program up, because I wanted to show all the people here that there's just like not one right way to do this. You can't just come in here and go, well, I'm a momentum trader and it has to be done. Like you only get vanilla or chocolate. Not at all. There's lots of combinations that you could integrate to fulfill what you're looking for. It's just a matter of you going through and figuring out which one fits your style, fits your mindset, and fits your comfort zone. Once you got that going along with the security you're trading, okay, then play it out and see what happens. But don't trade out of control. If you're tapping your finger on the desk, if you're consistently, if your hand shakes when you're grabbing the mouse, okay, something's wrong. You got the wrong strategy, you got the wrong setups, or you got the wrong security, or all three. You should be trading with comfort. You know what Don says? This is the greatest line Don ever told me. Don goes, you know you're trading the right way when you put in a trade and you walk away and go, I just don't care. When nothing bothers you. You're making money, obviously it's not going to bother you. But when you're losing money, you shrug your shoulders and go, next. You got to trade like you just don't care, but you can't lose control of managing your risk with trade size. Moving on, okay? Price, another price-based chart, meaning, again, I keep emphasizing the word time agnostic. I leave that up there ad nauseum because I don't want anybody to misconstrue what I mean. I literally repeat myself over and over because sometimes repetition, things start to stick after a while. So here's the Renko bars. Now, if you come to me, if anybody sends me an email, it's not necessary. I'm going to tell you flat out right now. I'm going to give away like, these are my secrets like Houdini. There's no secret here. Okay, my favorite intraday trading setup, okay, and I only use two. I either use Heikin Ashi or I use Renko bars. I use Renko bars 75% of the time, and I use Heikin Ashi 25% of the time. Or sometimes it's like 2/3, 1/3. So I'll give a little leeway. The idea here is this is my primary mode of choice. Okay. I love the bricks. I don't like wicks. I can't stand them. I like everything to be uniform. Okay. You see in this Renko bar, okay, if you want to learn more about Renko bars, if you want to learn more about momentum bars, if you want to learn more about range bars, because they all come from the same time agnostic mode, go into my archive. Go into it. Go into the candlestick category and look up what's called time charts versus tick charts. Or go look up, momentum bar, which range bars, which one's right for me. Go to both and watch them. Sit down, like I said, have a couple of cups of coffee, watch them from top to bottom. They go in complete detail for at least an hour to 2 hours on each single chart mode setup. It's phenomenal, okay? I don't have the time to explain it all here. I just wanted you to see optically what this looks like, okay? A green fill, it's a buy. A red fill, it's a sell. And you can see how the product, which in this case is the USD JPY, this is a perfect example of what? Of what? A currency. It's a FX product. Some of you may trade FX. Look at this. Stair steps down, stair steps up. So what you can see in this, you can see trend, you can see momentum, you can see swing trading, you can see channel trading. This is consistent with every single type of intraday trading strategy I'm discussing today. Channel, swing, and momentum. Take a look. Swing down, swing up, pause, back off, starting again. Look at that moment. There's a huge momentum run. Okay, that's corrective mode. Looks like a lot of noise. This filters out a lot of noise. It has no time attached to it, right? And you could see some of the larger movements. Like there's noise there. Oh my God, it's a reversal. And then the momentum continues higher. Oh my God, it's a reversal. Then there's a pop fake, a head fake, and then a drop back down. What you get with these is you can see traditional patterns, W's, V patterns, M patterns, head and shoulders. You can see traditional classical patterns intraday when you use Renkos better than any single chart mode out there. So if you were to ask me which one I endorse the most, I would say this one, but some people don't like this because they like to see the full range of the wicks. I'm not forcing this on you, and just because I use it doesn't mean you have to use it, but this by far is my choice. That's my preference. I love the Renko bars, absolutely love them, okay? And I also don't use them in isolation. I actually apply other indicators to use them. All right, now we're starting to get into the meat of the actual discussion itself, because we got through the strategies, we got through the modes, but there's so much more to gain. Remember, there's 60 slides, so I kind of have to move, at a certain pace. I will slow down and speed up at other times, but here I want to walk you through intraday trading indicators, okay? Each one of them is separated by what? Well, each one of them is separated by the trading strategy itself. So what exactly does that mean by the trading strategy itself? Well, look carefully when you look at this. Like, for instance, here's a momentum trading strategy, right? This is for momentum, right? Not necessarily momentum. Actually, you could have it actually in channel 2. But look, it gauges momentum. We've got the rate of change, which we're going to look at. We got the MACD, which we're going to look at. We got the fast stochastic, which we're going to look at. We don't use full stochastic intraday, people. And you're like, why? Because the smoothing factor makes it lag too much. When you're trading intraday, okay, speed is of the essence. So you got to cut down on the lag as much as possible. And the full and the slow are just not as responsive as the fast, and that's why I chose this over the other two. Here's another momentum indicator, the intraday momentum index. I haven't covered this too often. I haven't once before, but we're going to talk about it today. Then, of course, the impulse system, which I'm an absolutely die-hard fan of the impulse system. As a matter of fact, I often use the impulse system, and I mix it with the Renko. People are like, no way! Yeah, one of the things you get out of today is, okay, I'm going to show you towards the end of the program, I'm going to give you combos. So you can see how they all kind of interact together. It's like, like they're playing off each other, each one of the different setups. And you're like, oh my God, you'll start to drool. I had no idea I could turn the price action into something as colorful and as lucid as this. And I'm like, yeah, that's why I'm here. For you to slow down. Okay, I know it's intraday. I know the prices are moving fast. I know the market's volatile. You need to slow down intraday. Okay, you can't get caught in the washing machine or the chop, and that's why I'm here to give you the smorgasbord of all the modes and the indicators and the setups so you don't get caught in the undertow. Okay, then there's strength. That's another type of indicator. That's one category, that's another. Got the relative strength welder, and everybody who comes in this program, though, that's my favorite. Then you have the average directional index, which is another form of a relative strength, but it's formulaically different than that one. Then you have the exponential moving average, which is a trend indicator, but it also measures strength. Believe it or not, it measures strength. Then you got the VWAP, which is an institutional type of indicator that traders use in order to evaluate how to price the security accordingly, when to buy and when to sell. It's pretty much like a timing indicator, believe it or not, and it tends to be quite popular with very liquid products when institutions are trying to figure out how to scale in or scale out of a position on any given day. And intraday traders try to exploit the scaling by using the VWAP. So that's another cool indicator, right? So let's talk about momentum, okay, and the rate of change. First off, I don't call it the rate of change. Like, I'm sorry, you know how you like go to certain places in football, and instead of saying, hey, we're going to do a handoff, you know, we're going to do a running play, they just call a number. Let's do R12, right? Everything's in an acronym because it saves time and it saves having to say it out in its full expression. ROC is just another way of saying rate of change. So the ROC, okay, indicator, which is also referred to as simply momentum, they're interchangeable in a way, is a pure momentum oscillator that measures the percent change in price from one period to the next. It's pure because there's not multiple variables. There's one. This is as simple, okay, and as clear as it gets. But don't ever say the word simple means it's any less good than one that's complicated. That's a fallacy. I kept telling you, when you're trading intraday, you've got to learn this, okay? I sound like a broken record. Less is more on an intraday basis. Why? Because when you're trying to process information to make decisions to buy and sell and set your exits and entries and your bias, okay, because time is of the essence, if you have to process 100 pieces of information, you're never going to get the trade-off. You want to only have 2, 3, and at most, and that's a reach, 4 pieces of like indicators or information to evaluate to make a decision, because you've got to make a decision in a snap instant. So you don't want to have like, I have 20 criteria. What good is that? You only need 3. If all 3 say green, then buy it. If all 3 say red, then sell it. Keep it simple, people, because you're trying to make decisions quickly, but without being too hastily and without being what? Encumbered by too many what's called like filters and noise out there. Rate of change calculation simply compares the current price with that of the price N periods ago. The reason why I choose the word N periods, N means number of periods, because I don't know whether you guys are using 5-minute candle, a 10-minute candle, whether you're using a range bar of 14 periods backward or 10 periods. Okay, it's important to understand that the rate of change calculation is a function of the look-back period. That's all it's telling you, because it's using backward information to plot what's going on right now. The plot forms an oscillator that fluctuates above and below the zero line as the rate of change moves from positive to negative. So you're going to see this oscillating above and below a zero line. Think of rate of change as the rise, price change, over run. Ever heard that expression, rise over run, people? You ever heard that, right? All it's saying is, hey, price change over time change. That's it. In general, prices are rising as long as the rate of change is positive. Conversely, prices are falling when the range of change is negative. It's kind of very black and white, okay? Then here's other parts of the rate of change, like I want you to take hold. Rate of change expands into positive territory as an advance accelerates. And the rate of change dives deeper into negative territory as decline accelerates. So just as it is, it's a momentum indicator. So the more it climbs, the higher it's going to go above the zero line. The more it dives and it's getting hammered by sellers, the farther it's going to go below the zero line. So you can actually evaluate when the trigger is to go from bearish to bullish, and at the same time, when there's maximum bullishness, which means you should do what? Sell it. And when there's maximum bearishness, which means what? You should cover your short position. Here's the thing about rate of change where it has a limitation, okay? It has no upward boundary. It's not a max min. It's not what's called a bounded oscillator. So the ROC, the sky is the limit for an advance, and there is, however, a downside limit. Securities can only decline what? 100%. So which would be to 0. So there is a downside limit to it, which is 0, as far as the price of the security can go, but you can't tell me how high it's going to go. So it's kind of like a half-bounded oscillator, so to speak. Even with these lopsided boundaries, though, the rate of change produces identifiable extremes that signal overbought and oversold conditions as well as divergences. Very useful. So here's the momentum, right? Here's the rate of change in terms of the momentum. Can you see it here, people? Take a look. So this is a 1 day, 5 minute. This is just a candlestick chart, okay? And this is Tesla. So right here, when it crosses the zero line, that's a buy signal. Right here, when it falls below the zero line, that's a sell signal. You must look at the candles, okay, and measure them against the actual momentum or rate of change indicator, looking back 14 periods. When you see it trade flat near the zero line, what does that mean? No volatility. Means what? Be careful how you trade it. The idea is with the rate of change is to do what? To detect trends. This is trendless. From here up to here, it's completely trendless. All of a sudden, 10 o'clock the next day, because this is the following day, it's 1 day means 2 days of trading, Tesla explodes higher, and the momentum explodes higher too. Then it backs off. And a lot of times when it backs off, that's what people do. They short. Why is that a mistake? Because you're still above the zero line. The whole idea behind the momentum rate of change is what? Only buy when it's above the zero line and only short when it's below. But just because it's pulling back doesn't mean it's bearish. It's still bullish. It just means that the rate of change or the big money, the easy money here, that's gone away. It's just slowing down the gains and pausing. Then all of a sudden it takes off again. So a lot of people who shorted here got burned. Why? Because you fought the primary trend and then you have another reacceleration in the second half of the day. So this is an actual indicator of choice that a lot of traders like to use, and they're very anal retentive. They stick by their guns, okay? Their strategy is what? Only buy above the zero line and only short or sell below the zero line. My suggestion, you adhere to it. Don't break from what? Don't break the rules, and those are the rules. Then let's talk about the MACD. People who know me, okay, and it's no secret, okay? MACD is my ultimate favorite indicator. I started using the MACD in 1992. So here we are 26 years later, because I started getting into the business in 1991. That was when I was first licensed, 1991. So here we are, 27 years later, and I'm still hooked on the MACD. It's like I'm hooked on crack. This is it for me. It's my favorite indicator. It's got momentum, it's got trend, it's got primary trend, okay, it's got histograms so I can measure things. I love it. What can I say? I use it on any time frame and with any single mode. But here's the thing about the MACD, what the drawback is. If there's not a lot of vol, this indicator going to fail you. This indicator thrives on momentum and volatility. So if there's not a lot of volatility, whether it's a 10-minute candle, a 20-minute, or hourly, don't force the issue. Take the MACD and say, this isn't the day to trade it. The MACD only works when there's chop and price volatility. When it's like steady as she goes, and flat and grindy, the MACD, like it's your worst enemy ever. Okay, I'm going to tell you that right now. But the MACD is also known as the moving average convergence divergence indicator. It turns two trend following indicators, right, moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter. That's what it does. So the shorter dictates the direction. So as a result, the MACD offers the best of both worlds. It gives you trend following and it gives you momentum at the same time. The MACD line is the 12-day exponential moving average less the 26-day exponential moving average. Now here's the thing. If you're trading on an intraday basis, you're not using the 12-day exponential. You're using whatever candle or whatever Renko bar it is. So if you come at me and say, hey Jeff, I'm using a Renko using an ATR. Well, the ATR defaults to 14. That means your candle is not 12 days. It's the Renko on the NQ was 4, and you're looking back 14 Renko bars and taking an average. See how that works? You have to be very sensitive to this. Be very mindful. Don't skip this, okay? If you're using a 5-minute candle, it's the last 12 5-minute candles. But I'm using an hourly candle. Then it's the last 26-day hourly candles. It's going to convert to the actual time inside the intraday itself. It's not a daily indicator unless you're using a daily chart. Okay, that's what I need to point out. Closing prices are used for the moving averages, right? And the 9-day EMA, or the 9-day, or the 9 period, whatever that period intraday you're using, EMA of the MACD line is plotted with the indicator to act as a signal line and identifies turns. Then you've got what's known as the MACD histogram. You're like, what's the MACD histogram? Well, it represents the difference between MACD, right, which is your buy and sell trigger, and the 9-period exponential moving average, which is the signal line. Okay, so the histogram is positive, right, when the MACD line's above the signal line. And the histogram's negative when the MACD line is below the signal line. I will show you in just a moment what I mean by that, but we've got to walk through it. As its name implies, the MACD is all about the convergence and the divergence of the two moving averages. And people are like, what the hell does that mean? Well, the convergence occurs when the moving averages move toward each other. That's obvious. And obviously, divergence occurs when the moving averages move away from each other. So they're going to intersect, right, converge, then they're going to move in opposite directions. Then eventually they're going to come back together, meet again like it's a helix, a DNA helix. They're going to meet and they're going to kiss again, and they're going to go in opposite directions, right? That's what you have to understand. It's CD means convergence, divergence, which implies what? Momentum and price volatility, okay? Think about what I'm telling you here. The shorter moving average, the 12 period, right, is the faster and responsible for most MACD movements, right? And the longer moving average, which is the 26 period, is slower, it's less responsive, and less reactive to price changes. So the 12 is going to dictate the bullish or the bearish what? Intermediate or short-term directional move. A positive MACD indicates what? That the 12 days above the 26, or the 12 period, is above the 26 period. Positive values increase as the shorter EMA diverges further from the longer EMA, and this means upside momentum is increasing. Next time I do this presentation, I'm going to change this to period, because day, that implies, longer term time horizon. We're talking about only intraday here. And by the way, if anybody ever poses me the question, can I use the MACD on a 1-minute price chart? Of course, absolutely. If you're scalping for quarters or nickels, if you're scalping for like handles of 25 cents to 50 cents, then by all means use 1 minute, because you're in and out as fast as you can blink. The MACD will work on those time frames as long as there is price volatility. I told you that earlier. I had to qualify it. So negative MACD values indicate that the 12 period EMA is below the 26 period, and negative values increase as the shorter EMA diverges further below the longer. This means downside momentum is increasing. So let me give you a visual of what it means. Let me tie it all together in this one graphic, right? That is the MACD line. That is the signal line. So if the MACD line, which is the shorter of the two, is above the signal line, it's a bullet buy signal. But if the MACD line here crosses below the signal line, it's bearish. So you see how intraday it goes bullish, bearish, non-directional. See how you can't read this because the MACD is flat? When it's flat like this, people, don't trade it. You need volatility, or the MACD can fail you and actually work against you and cause you to lose lots of money. You need volatility or price movement. You need separation between the MACD line and the signal line. You can call this one the leader and that the laggard. That's your 26 period or 26 5-minute. And that's your 12 period or 12, that's the last 12 5-minute candles on Goldman Sachs. Take a look at this. Here's an explosion upward. See right there? See how it got above there? That's a buy signal, and there's a push on Goldman for like $1.50. There's a couple of dollar movement. And that occurred in less than 15 minutes. See that early in the morning? That histogram is what? Okay, when the histogram is above the zero line, that means that the momentum is bullish. When the histogram is below the zero line, like over here, it means it's bearish. And you can see the momentum starts to gain as the histogram bars get higher. But as the histogram bars dive lower below that zero line, that means momentum to the downside is what? It gets stronger. So you can obviously see momentum up, momentum down. Now, put this thought process in your head while I'm showing you this. If you're a momentum trader, this product is ideally suited for you. Think about it. Are you a swing trader? This product is probably ideally suited for you. But if you're a channel trader, it might not be suited for you. Then you're going to come back at me and say, well, Jeff, you told me you are a channel trader. I am. But I don't always use the MACD for channel trading. I very rarely use it. What do I use for channel trading? You're going to find out, because there's more indicators on the way. But this is ideally designed for momentum. So for momentum and trend traders, okay, this is right up your alley. And the histogram bars alerts you to the momentum to the up and downside. Love this stuff, okay? Moving on. Trying to take census, because we're going to take a break in about 15 minutes. Again, I'm only on slide number, what slide am I on? I have to go through. I'm on slide number 27. And I've got like 30 to go through. And plus I have to show live trading, which is the funnest part of this whole program. All right. Another momentum trading indicator is the fast stochastic. Okay, the fast stochastic is another momentum oscillator, but it's not like the MACD, and it's not necessarily like what's called the rate of change. It compares the closing price of a security to the range of its prices over a certain period of time, 14 periods. That's what it does. One of the things you're going to find about the fast stochastic that separates it from the actual rate of change is that the rate of change only has one single plot, and the trigger is the zero line. But in this momentum indicator, the zero isn't necessarily the trigger line. It's the 2080 threshold levels, and this has two plots. So the triggers come from what? The triggers come from the interaction of the two plots, kind of like the MACD, plus where they interact on the threshold level, which is 80-20. So the fast stochastic, which I call FS, the oscillator follows the speed or momentum of price. So as a rule, the momentum or speed of the price of a stock changes before the price changes itself. I cannot explain that. I'm going to repeat that again, because this is the difference between a person who's a great trader and a person who's an average trader, okay? The momentum or speed of the price of a stock changes before the price changes. So people are like, oh my God, I want to short that. I can't wait till it peaks. If you're waiting for it to peak, don't look at the price. Look at the momentum, because the momentum will slow down and then eventually reverse. So the trend doesn't change first. The momentum changes first. One of the things that burns a lot of intraday traders who swing and who channel trade is they're trading according to trend and they're not trading according to momentum. That's a mistake. Momentum changes before trend does. A change in momentum will always precede a change before trend. So in this way, the stochastic oscillator can be used to foreshadow reversals when the indicator reveals bullish or bearish divergences. And we'll get into that as we move through the program. I promise you. Stick with me here, folks. I promise you we will actually kind of get through all this stuff. All right? So here's another thing. Considering the most traditional settings for the oscillator, 20 is typically considered the oversold threshold, and 80 is considered the overbought threshold. However, the levels are adjustable to fit security characteristics and analytical needs. What does that mean? Some traders will adjust the stochastics. The traditional stochastic designed by George Lane is an 80-20 split. It has to add to 100. Okay? Some traders will do 70-30 or 60-40 or 65-35. They'll actually skew the thresholds of overbought and oversold. You can do it, but I don't. I'm old school. I like extremes. I stick with the original pioneering formulas. I don't mess with them. But if you do, I'm not going to castigate you or shed bad thoughts on you or send voodoo signals your way. Go for it. Do whatever fits your happiness comfort zone. Readings above 80 indicate a security is trading near the top of its high-low range, whereas readings below 20 indicate the security is trading near the bottom of its high-low range. So if you are a channel trader, this indicator is a must. If I ever see you guys as a channel trader not using this, I'm going to go nuts on you. This is designed for channel trading, whether it's what? Horizontal channel trading, ascending or descending. It doesn't make a difference. Okay? So what does the fast stochastic look like? Well, there's the 80 and there's the 20. It's plotted for you. You can change it. You can go into the edit studies and change it. But the 80 means overbought and the 20 means oversold. Overbought does not mean sell. Stop it. It's a condition. It's not a trigger. Okay? The trigger is the actual plot itself. So a lot of times when it gets overbought, people short. Look, this was overbought here, and then it ran another dollar. Just because it's in the overbought zone doesn't mean it's a sell. It means it's the recognition it's near the top of its high-low range, which means the high range. But also recognize that the triggers are given by the actual interaction between the fast stochastic K and D lines. There's a leader and a laggard line. What's the leader and laggard? The leader line's the red line. The laggard line's the blue line. It's kind of like the MACD, but it's not based upon the same MACD formula. But the concepts are the same. It's the interaction between two plots who converge and diverge. When they cross below the threshold and then diverge, then you get short. So in this example, the price action's going higher, but you have a bearish divergence, which means what? Eventually, this thing's going to get tagged. I don't have my pointer in this example, but look how the price is going higher, but the actual stochastic's going lower. That's foreshadowing a sell-off in the stock. And needless to say, where does the sell-off come? It comes about 20 minutes later. But eventually it does come. So this lags a bit, but it has good advance notice of when a reversal is about to take hold. Always look for when the price moves one way and the oscillator moves another way. If the oscillator and price move together, don't fight it. Don't short it. If the oscillator and price are moving downward, like right here, don't buy it. You're fighting an incredibly overwhelming bearish trend. The supply is too much and you're going to get smashed. It finally bottoms out here. I can see it. People are buying here. You're buying prematurely because it could be oversold and melt lower for another 20 or 30 minutes. The idea here is wait until both lines cross, they converge and diverge as they get above. There's your leader line, which is the red one. It gets back. So it's catching what? The swings intraday. So if you're a swing trader or a channel trader, this is a must. If you're a momentum trader, it's not necessarily a must. Not necessarily, but it's still good to have just to make sure you're not chasing too late in the trade. But it's also good to have because as a momentum trader, you want to buy into an overbought condition and you want to short into an oversold condition because you're chasing the power of the move itself. You just have to make sure that when the actual momentum changes and shifts, you're out of it. Then you've got what's called the intraday momentum index. Okay? Guess what? It has the word momentum in it. So you know what? Yeah, it's a momentum indicator, of course. That's why I brought it up. So what does the IMI have to offer that the stochastics and the MACD and the ROC don't? Well, it's a little different. Okay? It's the way it's formulaically constructed and the inputs themselves change. Like for instance, the IMI considers the range of price action within a given period, usually a day. So on an intraday basis, instead of measuring the ratio between period 1, up close or down close, and period 2, up close or down close, and so on, instead the IMI considers the relationship between the open and the close of each day. So what this does is it filters out the noise of the actual intraday range itself and narrows it down to what's called the primary range. Like you could have a candle that goes from 100 to 96, and that's a $4 range in a day on an intraday basis for a stock like, MasterCard, for instance. Hey, it moved $4. The IMI will filter out that $4 and find you where the beef of the range is. So the full range might be $4 intraday, but the IMI will signal saying, look, it's $4 intraday, but all you really care about is this price point and that price point, and it will narrow the range down to $2, to maybe like 98.96 or 97.99, so that you don't get caught up in the broad range, but gets you caught up inside the momentum range of where the actual price action is being fought. That's what this does. So the intraday momentum index is the sum of the up periods divided by the sum of the up periods plus the sum of the down periods. This quotient, as it were, is then multiplied by 100. Why 100? Because they're going to percentagize it, right? To arrive at the IMI number, a number between 0 and 100. So like the relative strength index, which we'll get to, which is a strength, again, that's in the strength category, 70 is generally considered an overbought reading and 30 an oversold. Now that contrasts with what? Yeah, that contrasts with the stochastic, because the fast stochastic, what's the overbought, oversold range? Yeah, it's 80-20. This one, it's not 80-20. What is it actually? Okay, it's 70-30. But the average period to be considered by the IMI can vary, although 14 is a commonly applied period length. So when you use the RSI, the look-back period's 14. When you use the MACD, it's not 14. It's 12.26. When you use the ROC, it's 14, right? And when you use the fast stochastic, it's not 14. The fast stochastic is set to 10. So each one of them has different look-back periods. Notice that? The fast stochastic, MACD, and the IMI all have different look-back periods. So what does that mean? They all have different sensitivity and lag effects. They're not all created equal. So choose one, but don't choose three. Settle on only one and one only, and don't get yourself messed up. Understand the differentiation between those look-back periods. 14 is the commonly applied length. So what does the IMI look like? Well, it kind of looks like an RSI, but it's not. In the other example, right, in this fast stochastic, it's 80-20, and you've got two plots. This has one plot. People are like, that looks just like the ROC. It does, but what's the difference? The ROC is unbounded, or it's half-bounded. This is fully bounded. It can't go above 100, and it can't go below 0. So it stays bounded inside this range. It's a range-based oscillator, and it's a single oscillator plot. So where do the buy signals come? Well, it depends. Here, When it starts to tag that 30, it's oversold. So you should be getting out or getting a little bit long. Where should you be getting out in this trade? As close to here as possible. You see how that was a sell there? Well, when do you get back in? You tend to get back in when it hits 30. So that's a buy signal. Go through and come back, buy signal. Tag, sell it. But be aware that this can stay overbought. This was overbought for nearly 2.5 hours. You can't just assume because it's overbought, it's a sell. You need it to get overbought and then move away and diverge away from the overbought condition. When it's hugging the line, it becomes very, very what I call iffy. You think it's time to get short, and you put on a short trade, and you get burned because it runs higher. Because why? Because the fact of the matter is it can stay overbought for a while. This was only oversold for a little bit. Even when it pulled back, there was what's called a bullish divergence. You must look at the price action and make sure the price action is what? Consistent or mimicking the actual IMI index. If you don't, you'll get burned. Why? Because in this example, the price action ripped higher and the IMI went lower. Okay? What does that mean? It means that the IMI is portending a sell-off. Did it materialize? Didn't necessarily materialize. But if it did materialize, it means you could have bought it here while it could have reversed and headed lower. So pay attention to the candle, pay attention to the trends of the candles, and pay attention to the IMI. It just moves in overbought, oversold kind of conditions, measuring momentum. And when the momentum gets above 70, it means it's tremendous buying pressure. So like right here, towards the end of this example on a 5-minute on the Adobe, right here, a lot of people got short. That's a mistake because look what happens here. It runs from 171 half to 173. You lost another $2 because you didn't respect the fact that the momentum was still in place. Momentum in this business is a very powerful aphrodisiac. It can lull in the smartest and the dumbest of people. It can even fool the computers at times. So be very careful how you read the momentum. Me, I don't use this as much, but traders like this because of the way it filters out a lot of the ranges and gets right down to the heart of the momentum. All right, one more and we'll move on in 5 minutes to a break. We need a break. I need a break, Jeff. If you don't give me a break, I'm going to beat you to a pulp. I get it. There's a lot more to go through today. So the momentum, the impulse system. What's the impulse system? Well, it identifies the inflection points where a trend speeds up or slows down based upon two indicators. It actually embeds the 13-period exponential moving average and the MACD histogram. So it steals a little bit of the MACD, but not the MACD formula itself per se in its purity. It steals the histogram part of the formula. So the moving average identifies the trend, that's the 13-period, while the MACD measures what? The momentum. So you have trend and momentum embedded in the same indicator. But here's the rub. As a result of their combination, the impulse system combines the trend following and momentum to identify tradable impulses, hence the word impulse system right there, that are color-coded into price bars for easy reference. Now you can ask me, do I use the impulse? You're damn right I do. I love the impulse system. I'll use it probably once or twice a week, depending upon the stickiness of a product. So when it comes to products that aren't altogether that momentum-based, or even some that are, I'll use the momentum, the impulse, as a filter. What do the green price bars mean? It shows that the bulls are in control of both trend and momentum as the 13-period EMA and MACD histogram are rising. The red bars are what? They're bearish. They indicate the bears have taken control because the 13-period EMA and the MACD histogram are falling below it, right? And the blue price bars indicate mixed technical signals with neither buying or selling pressure predominating. So I'm going to simplify this for you, okay? This is as easy as it gets. Don't go kill yourself buying books on this. Don't go to the internet to read like a 30-page, type of like War and Peace novel on this. It's color-coded. Buy when it's green hollow, sell when it's red, and don't trade it when it's blue. Don't get bullish or bearish when it's blue. It could be blue filled or blue hollow. It still means it's a neutral reading. It means leaning bearish, but no decision. That's clearly a momentum sell. So sell there. See how it's green? Cover there. Okay, buy here. Sell when it turns red. Buy here. Sell there. Cover your short here. Go long. Okay, don't trade here. All you do is follow the color codes. If it's blue, don't do anything, but recognize you're in like neutral. You're in a pause position waiting for the next candle to give you the signal. If it's green hollow, you can buy it. If it's red, okay, you can short it or you got to sell it if you're long. Just follow the system. Remember, this is a function of time. It's a time-based system unless you're using what? Tick or unless you're using Renko. So be aware that this is based upon a time-based system. So these, right, okay, they have to have the candles plot in order to do this. If you switch to, let's say, a non-time-based system, this plot's going to look entirely different. And if you change this to a 10-minute candle or a 20-minute candle, it's going to look even more funkily different. There's going to be less candles plotted, but the color sequence will change. So the color sequence that's being actually plotted by the impulse formula is a function of the data that's being plugged in. So if you change the candlestick type and change what? The numeric type, it's going to make this the impulse buy and sell signals and neutral signals look entirely different. So be very careful that if you choose the impulse, what's more important, the impulse or the chart mode? The chart mode's far more important than the actual indicator. Get the chart mode down first, then decide upon whether you want to use the impulse. On that note, we have now reached the hour and a half